Well, hello. What's up, everybody? We are gonna get started. Joe Henson, welcome back, Grant. Hope you had a hell of a time. I did have a hell of a time. Thank you very much. This was a fantastically wonderful vacation time of mine. Hope you guys can hear me all right. I'm going to assume that you can, unless I hear otherwise. Let me move this chat to a larger window for myself so that I can see you guys better. Ika is with us again tonight. Ika up in the house, taking care of our chattins. Hey, hi, it's been 2 weeks. I've missed you guys. Thank you for my welcome backs. I appreciate it. It was a wonderful time that we had. We got to spend 2 or 3 days in Tokyo with our friends, which was awesome. We had a group of 12 that went out. Yes, Andrew, this is the place. Enter questions just through the chat. John, you made it. Awesome. I love that. Oh, Homero. That's awesome. I'm glad that you joined, man. I'm glad that you joined. That's awesome. I'm glad to see you. So yeah, we spent 2 or 3 days in Tokyo, and then we spent the rest of the time, 8 or however many, maybe it was 3 or 4, I don't know, we were there a little over 2 weeks. We spent the rest of the time on this little island called Yakushima that is south of Japan, and it's basically a fantasy land. Their version of Disney is a guy named Miyazaki, did a movie called Princess Mononoke that was my wife's favorite, and this island is where all the inspiration from all of the art came from, and so that's why we found out about it in the beginning. We went there 4 or 5 years ago. It's got like 13,000 people on the entire island, but like, dude, it's ridiculous. There's mountains, the beautiful beaches, you're walking around with like monkeys and deer, and like, I promise I'll actually get into real estate here. Halfway expected me to be in a kimono. Man, those things are expensive. But like, dude, straight up oops, sorry, I just tapped on that. That was probably really loud. When the water goes out with the tide, so there's like this 3-hour period of every day where you can go out and it exposes these like hot springs and lava rock, and you just go chill in this hot spring and hanging out with the mountains behind you and the ocean in front of you. And one of the locals was there, and it was cool because there was a local in there and us and this couple from China. This is what would you call it? Not like mixed sex, like the guys and girls go in these hot springs together, which is not normal. But we knew just enough Japanese, or my wife did, to speak to the Japanese guy who knew just enough English to communicate with us, and the Chinese couple, which one guy knew just enough English to communicate to his couple wife in Chinese. So it was kind of cool. But the local there told us like that's where the blue whales are out there. So you'll be sitting, whatever season it is, if it's spring or whatever, the blue whales come around. I don't know. I'm not smart. You'll be sitting in this hot spring with like the mountains on one side and the ocean and all the lava rock and all the beautiful waves, and you'll see like the spouts of the whale and the tail slapping and all that kind of stuff. It was just freaking, it was amazing. So yeah, that was my time. Thank you guys for affording me the time to go, for being so generous. I know a lot of you guys just joined in this like recent past, and so it kind of sucks when you just join in and I take a 2-week vacation. I want to be clear, I don't take vacations very much, especially not on Mondays. I try very hard to make sure that we are here for you every Monday night. This one was just, hey, we got round trip tickets for $450. What else are you gonna do, right? So we went out there and did that. So yes, let us get going. So for those of you who are joining and do not know, the way that we run this is that if you run into like a question that you've got in the like middle of the week or something, you're like, crap, I know I'm gonna forget this by the time I get to Monday. The thing to do is just email it. questions@CreativeCashFlow.com. We will get to those questions during the next session. We cut off at 6 p.m. on Monday, so you got to have that question in by 6 p.m. the day of the stream if you want us to address it that week. Other than that, I would really prefer if you would participate in the chat feature that is on YouTube, because I like just kind of the exposure of having everybody talk to each other and all that kind of stuff. Everybody seeing the questions as they come through, and quite frankly, I think YouTube likes that chat participation, and even though this is not a listed video, this is private just for you guys, it is unlisted, it will help me if YouTube thinks that people like talking to me. So I would prefer to have the chat questions come through that live chat on that. My wonderful, fantastic virtual assistant, Ika, is helping us. Everybody say hi, Ika. And what she does is she takes all the questions from the email, she takes all the questions from live chat, she puts them into a Google Doc, and that is what I'm reading up here, so we can kind of get through those questions. So to answer a couple of the questions that have come through from Deverson and from Andrew, this, I like how Andrew asks, is this where my questions go? And the first question is, where are my pajamas? I didn't know you wanted pajamas. Is that the question that we've got? You get one question, by the way. That's it. One question. You're done. I'm not going to answer any more questions. You used it on where are my pajamas. I like to think that he's just like randomly asking that. Like he's sitting there naked, just literally wondering where his pajamas are right now. He's just losing his mind slowly. Not to say, Andrew, that I like imagining you sitting there naked, but I literally did just say, I like to think of him sitting there naked. All right, let's do this. So I'm going to hit some of these questions. I would love for you guys to participate in the chat with each other, just kind of talking. One announcement before we do get started in the questions. Make sure, if you are watching this and you have not yet joined our Facebook group, that you go look for the CCF Mentors Facebook group and ask to join that. If you don't have that link, you can go to our website in the chat box and ask Ika. If she doesn't already have that, Ika, if you don't already have that, I'll provide that link for you so you can give it to them. We're working on an email that'll go out to everybody as soon as you sign up, but I don't think we have that one there yet. I'll have to check with my copywriters and project managers on that. So we'll eventually get that out. But if you're watching this and you're not part of the Facebook group, please become a part of the Facebook group. That's there for you as the community to help the community grow. Monday night is here for me to help the community grow, but I'm not the end all be all. I know a lot of stuff. I don't know everything. There's people out there that know a lot more about certain areas than I do, and I'd love for you guys to create those relationships, create those JVs. That Facebook group is the way to do that. So get joined in there. I will try to pay attention a little bit to the chat, but as I found, the chat can get really busy, so I may not see all of your random conversation pieces, but we will get all of your questions. That's why Ika is here paying attention. Oh, cool. Our link has been linked here by Sean and, oh gosh, what is it? Sean and, oh, I'm forgetting your name. I'm so sorry. Hot Pink Home Buyers. Ah, dang it. I'm trying so hard. We've got just the usernames makes it difficult. It's where all the cool kids hang. Exactly. All right, cool. So let me get going on the questions. If direct marketed to homes as, well, I'm going to read it as is. If direct marketed to homes, oh yeah, this is something I was doing for you guys the other day that was helpful. Let me do this. See, we're still learning over here. I want to make this your best possible experience. Skirt. Hey! All right, if direct marketed to homes are as targets for sub 2, what criteria would you use for those mailers? Actually, I'm going to turn my screen a little bit here. I had it more set up for my battle station than I did for my streaming. It'll make it easier for me to read. What criteria would you use for those mailers? For example, would you use free and clear targets, homes with X percentage equity supposedly in them? What's a great price or value versus local rents equation you'd use? I really need to leverage a combo of driving for dollars, networking, and things like that. Whoa. Ika's making it bigger for you guys. Really need to leverage a combo of driving for dollars, networking, and things like direct mail or cold calling as things have stalled out. Yes. So first, let me just address that very last 3-4 words. Yes, things have stalled out. Things are hard right now, guys. Vicky, dang it. Yes, Vicky, I knew that. Sorry, randomly. It was Sean and Vicky, Hot Pink Home Buyers. Things are tough, guys. Just across the board. There's a lot of people. There are people that are very successful right now, and I don't want to. My next statement is not to take away from the people who are very successful right now. But my next statement is to warn you that the people that you see that are so successful on Facebook, I know enough people. I know enough closing people. I know enough of the behind the scenes. I know enough of the folks who will openly admit behind the scenes to closed doors that they are not doing as well as Facebook would make it seem as they are. Don't get discouraged by the Facebook, I'm doing awesome guy. Everything is hard right now. It's a hard cycle. You guys are smart because you're learning a strategy right now that is going to just punt your career into, is that the right word? Punt your career into skyrocketed numbers when the market shifts. When that down cycle occurs, the owner financing stuff is going to shine highly. So you guys are prepared when everybody else is going to drop off. I don't have a real stat, but when the cycle corrects, 80% of the people out there are going to die. They're just going to go away because right now, for the last 4 or 5 years, all it's taken to be a great investor is time. All it's taken is buying a crap deal, waiting long enough until it's no longer a crap deal, and then getting your butt saved by the market. That's not how investing works. And when that correction occurs, everybody else is going to die. You guys are going to be the ones that know how to handle stuff and know how to get in to do deals. And if you look at the people who are like most flaunty successful, when I say flaunty successful, I just mean worthy of having flaunt. Pretty much everybody made their money in the downturn. Now's not the biggest time to make that. So I just want to help mental states if you're getting discouraged because things have stalled out. That's okay. That's okay. Try to get your deals where you can. And as the market shifts is when we will start to hoard and hoard and hoard and hoard. Right now is a good cash deal time, but they're harder to find, admittedly. Okay, so the question here being, if we are marketing for sub-2 homes, where's my mouse? What criteria would you use for those mailers? I will give you an idea that, so subject to, particularly, is really good in low equity. So there answers your question for the homes with percentage of equity. Think about like what a wholesaler needs, what everybody else is marketing for, and then knowing that you can hit an equity level that's less than that. So low equity is good. I will tell you a tip, which is the majority, most of the deals that we're going to do, subject to, excuse me, is the mortgage is going to be 2 to 8 years old. Okay, if that helps any. I don't go for free and clear sub-2 because that's not sub-2. Sub-2 has to have a mortgage. That's how sub-2 works. You can go for free and clear if you're going to do just an owner financed offer to folks, and that is very viable as well. But yeah, 2 to 8 years old, homes with low equity. The price point that I stick at is going to be a 250 or below. One of the big reasons being that I didn't even see the actual question. I just see Geraldo go, what the hell? Not semen. Oh, that's going to be an interesting night tonight. Sorry, that made me completely lose my train of thought. Was I? Oh yeah, I stick with 250 ARVs and below because one of the big reasons is when you are asking for a 10% down payment from your buyer, what is the likelihood that somebody has, I really don't like going above 200. I cap at 250. I really don't like going above 200. The likelihood that somebody has $10,000 for a $100,000 house is much higher than the likelihood of somebody who has $25,000 or $30,000 or $40,000. So I don't mess with those higher end properties because I need a 10% down payment from my buyer, and we have more buyers with 10% the lower that price point is. I will also kind of throw that out and say whatever your market's median price is, that should probably be your cap. Because like in California, $250,000 might get you a trailer. But also people get paid more, so the likelihood that they might have $25,000, $30,000 is also more likely. So I say whatever that median price point is, our median is $249, I think, right now. That's kind of where to stick. And you can look those stats up online. Were there previous slide outline notes for the insurance structuring chapter? I want a handy checklist of how things need to be structured for the various deal types, i.e. sub-2, owner finance, free and clear, something clean and complete so I can have that set process which needs to be executed on each deal kind of thing. So a VA or assistant can help with that stuff. No, I don't have that, unfortunately. If somebody wants to make that, I will gladly help distribute it, but I just haven't spent the time to put that in, quite frankly. 3-point win. Win 1. Me again, Chapter 14 Insurance. If you link a POA with the seller and open an account at that major bank, I'm assuming, so that POA is on file in the event you need to cash an insurance claim, is that the only reason that the account is being opened with you and the seller on the name of the account? What else may it be used for? Should it be used for? Absolutely nothing. The answer to your last question is yes. Are there any reasons that this may bite me and my LLC in the ass? Not really from what I know. Again, I'm not a lawyer. I should have a button that says I'm not a lawyer and have it, but I'm not a lawyer. I'm not. Here's the thing is, maybe I should go back and rewatch that insurance video that we've got up there. I re-recorded one with James Jenkins, who I recommend you guys at least check out and talk to him. I haven't done really, I don't know if I've done any of my raps through him yet, but he's sharp and he knows what he's talking about, and I've vetted him and he knows what he's talking about at least. And I have used him for a couple of other things like builder's risk on that. Anyway, the point of the story here is our best practice internally that we do with insurance claims. So here's the scenario for somebody who may not be necessarily following up so far. Is we buy a house subject to, okay, meaning we're taking over on payments. Then we sell that house with a wraparound mortgage. Now, on the insurance documents, we have to have the seller's name as an also insured. We have to have our buyer's name as the named insured. Remember, I will always use the same verbiage. Our seller is the person who sells it to us. Our buyer is the person who buys it from us. Buyer's name is named insured. Seller's name is also insured. The sub-to mortgage company, Bank of America, Wells Fargo, is listed as the primary mortgagee, and our LLC is listed as the secondary mortgagee. Long story short, we have had to go through some extreme lengths sometimes in order to be able to, so if let's say, now take that a step further, a hail damage occurs and our roof needs to be replaced. Well, the insurance policy is going to send a check for $5,000 and we need to get that money into a contractor's hands. That check is going to have our buyer's name, our seller's name, our primary mortgagee, Bank of America's name, and our LLC's name on it. That check cannot be cashed until everybody's name has signed off on it. Now, what he's addressing is one of the ways that we are able to get that cashed, which sucks. I don't want to go into it too much because I'm going to actually encourage us to do another way, which is now our best practice, which we have found a lot of success in over this last few years. That insurance video I filmed was probably before we really solidified that this was our best practice. What we do now is we get that check in the mail that has everybody's names on it. Before anybody touches it, we send that, we mail that to the Bank of America, Wells Fargo, and have them endorse it, but it cannot be signed by anybody else or else they won't endorse it. They endorse it, they mail it back, okay? So you can just call them and ask where their insurance department mail goes to, and you've got a check that they need to endorse, that kind of thing. They will endorse it and mail it back if it's under a certain threshold, which pretty much everything is since we're in this price point, so I'm not going to complicate things further by talking about the edge case. Mail it back. Then you are going to take that check, which has now been signed by Bank of America. You're going to ask your buyer to go with you to your local community bank, which you have your business account with, which is not Chase or Wells Fargo or Bank of America. You should not be banking with them for your business banking account. You should be banking with a local community bank. The relationships are much easier, and many, many other reasons. One of the big reasons is for this exact scenario. So you get the check back in, you take your buyer, the physical, actual human being with you to your local community bank with this check and the power of attorney for your seller. And you take that check to your teller, you use your power of attorney for your seller to endorse the check for your seller. This is why you use the community bank, because they're not stupid and they actually understand that powers of attorneys are legal documents by the state, promulgated, and can be used for this. You endorse it as them, you endorse it as your entity, your buyer endorses it, and then you deposit that into your bank account, your entity's bank account. From there, once it clears, you cut a check to your buyer, or if it is your internal policy, which you need to have a written policy of, it gets deposited and you do checks of the work that's being done to the, like say for instance this roof, and you cut the checks directly to the contractor. That's the best practice. I would avoid, so you can do what you were talking about. That is probably in my video. I have done that once or twice before. I would avoid doing that anymore, knowing this best practice here. Also, if you have a replacement value, and if that is traditionally designed to cover the seller's mortgage company's owed balance, and if we structure a wrap to an end buyer for a higher loan amount, of course we will, then how does that policy need to be structured so that our higher balances is paid out, so the seller's mortgage company is also covered, and so our higher wrapped loan balance is covered? That's fairly easy. It's just you make sure that the covered amount is whatever your borrower's loan balance is. That's going to be your covered amount. Grant, when I was sitting in the closing for a house, woo, yay! One of Scott Horn's people asked if they were supposed to write a restriction into the contract about paying off the loan early. Can I restrict the payoff or the sell of the house by my buyer? Or can they only write an early payoff penalty? That's an interesting one that I haven't run into. I'm curious what conversation would have brought that up for them. But it actually kills you cannot have a qualified mortgage, a Dodd-Frank QM, which is what we want for the court protections that we're looking for, if you have a prepayment penalty in there. So there shouldn't be, I'm curious what the conversation was that led to that, because we wouldn't ever want to do that unless there's something that he knows that I'm unaware of, but the likelihood of that in this particular case is very slim. I'm curious of that. Grant, I know a flip pricing model of ARV times 70% minus repairs to buy a house from the seller. For seller finance purchases, you talk about paying for the repairs out of the monthly play money. Is there a way to subtract the repairs in the owner finance model when buying from the seller? Yeah, absolutely. So this goes into what we talk about often with our rules of thumb. Okay, so let's get fancy, because that's how you say fancy. And let's talk about rules of thumb. So to go over those, we got two major rules of thumb that I like to work off of. One is what I call my 2 times cash. And that means that the ARV minus loan is going to equal your equity. I mean, that's not what the 2 times cash means. It's just, we know that that's what it is. ARV minus loan is going to equal our equity position. I want whatever your cash input is on this deal, repairs, arrearages, that kind of thing, I want you to take the cash, multiply it by 2, and this should be equal to or less than the equity. So maybe I had already written that. Maybe I would do it like this. So 2 times cash should be equal to or less than equity in the deal. Okay? Again, that's all the cash that it takes to get this deal done up front. Rehab, arrears, all that kind of stuff. But sometimes it's unreasonable to expect 2 times cash to be a thing. Sometimes, let's say it's a $100,000 house with $50,000 worth of arrears and repairs. You know, $30,000 in repairs, $20,000 in back payments. Well, it's unreasonable to expect 2 times cash to be a thing, because then it would have to be in free and clear property for that to happen. So the caveat, the next step, is going to be, I want your total basis to be around 82%. These are rules of thumb. Rules of thumb. Reason I'm clarifying this is that you may have a reason to break this rule of thumb. So when I say total basis, what do I mean by that? I mean your arrears plus your, well, basically all your cash plus your loan balance. Everything, your total, what are you in it for, should be about 82%. But what if you're in it for 90%, but you're making an $800 cash flow? Might be worth doing, right? So it's a rule of thumb. You might break it. That's okay to do, all right? So that's kind of how you account for repairs in this, is say it's a lot of repairs and you're going to take out a loan from a private money lender to handle this. I want you to be all in at about 82%. It's the most protective way for you. All right, so let's get back over here to the screen. And let's say, how are you getting the notes? I mean, generate the leads and get the deals. To whom are you selling the note to? Or are you just wrapping them and keeping them? Do you sell notes at what percent? How do I calculate the discount, etc.? Etc. is not a question. That's from John Alvarez, Mr. John down in Austin. Okay, so we're not getting notes, we're getting properties. We create the notes. I want to be very clear on this, and I'm not a lead gen expert. That's not my thing. I'm a deal mechanic. If a deal gets in front of you, I will show you how to make money on it. I'm not your savior in lead gen. So unfortunately, I wish I was. That'd be cool, but I'm not. That's not my thing. That's not my area of expertise. I get fewer leads than everybody else, but I close on my leads, and that's kind of the difference. But the answer that you're not going to like me saying, but is the truth, is that they're in all the same lead lists that everybody knows. There's nothing sexy there. You're hitting the same exact pre-foreclosures, tax delinquents, vacants, whatever. Any other list that you've ever heard of, that's where these deals are. To whom are you selling the notes is, I'm not telling you. You're going to sell it to me, and I'm going to make a little bit of money in the middle, because that's part of one of my profit centers. But the reason why I'm able to do that is because my note buyers buy my notes at ridiculously high amounts, so I can shave off a point or two, and you can still get a larger offer than 98% of the other note buyers are going to ever offer. So, which leads into, what percentage do you calculate the discount? I'm gonna answer this in two different ways. You should calculate the discount. Well, here's the thing. Let me show you how that's calculated. So the way that it's actually calculated is, let's say that we've got, so right here, I've already got it up. We got a 9.5% mortgage at 30 years, $90,000. The payment is $756. So if we take this 9.5, I need to adjust my how tall I can point. If we take that, hold on, oops, am I doing this right? No, I'm not doing this right. That's gonna annoy me enough that I'm like actually gonna fix that right now. So forgive me as I do something that totally doesn't matter to you guys. Okay, now I can point high. If we take this 9.5, that's gonna be the thing that note buyers care about, is their yield. They want to know what yield they are getting. So that's what matters so much in the note space, is that when you're calculating what discount you're going to take, even though the offer is going to be made to you in such a way that they say I will buy your house, or I'll buy your note from you at 82% of the UPB, which is unpaid balance. What they're really doing is they have an internal number that they need to hit. They want their money to make them X amount of dollar or percentage. So another way to phrase what we are looking at right here is that if I have $90,000 on the market and I have 30 years left on my payments, and those payments are $756 a month, I am getting a 9.5 yield. Okay? So I want you to, I'm gonna say that again, because this is very important to understanding how the note space works. If I have $90,000 on the market and I am being paid $756 a month for the next 30 years, that means I am getting a 9.5% yield. Now, the note buyer typically wants somewhere in the 11 to 15% range of a yield. So if we go in there and we say, I have a note buyer that wants an 11% yield. Well, we're not going to modify the 30. That's how many payments the loan still has left. That doesn't get changed. We're not going to modify the $756 a month, because that's what the borrower has been told they are going to be paying. So in order to get them a yield in order for the $756 a month for 30 years to yield them 11%, we need to change the PV. So that's what we solve for. In this case, the PV would then be $79,465. So they would offer you that dollar amount, which is 88% of the UPB. That's how it works. That's how the calculations are made. Now, so what that means is the lower yield requirement that a note borrower has, the better offer you are going to get. I typically get 93 to 97% UPB on my paper. But my paper's good paper, and it's got great borrowers in it, and it was properly underwritten, and we've got seasoning behind it. Note buyers almost always want a 6-month seasoning. Getting 90%, I see John say, I want to sell the notes at 90%. Good on you. Everybody wants to sell their notes at 90%. There are buyers that will buy it at 90%. I have buyers that will buy it at 90 or above. Depending on the strength of the paper, depending on the strength of the borrower, is going to change what their yield requirement is on that note. Most note buyers are buying in the 75% range. So don't necessarily count on getting 90 or above, or even 85 or above, even though there are note buyers that will do that. Don't necessarily count on that. But I do have note buyers if they're in Texas. Actually, I've got note buyers nationally too that would work for that. But I can typically get you a yield if you're bringing me a note of 87 to 90% because I'm typically getting an offer of 88 to 92% for paper that comes from outside sources. So what I'm doing is if I get a 92 offer, I'm giving you 90 and I get 2% for making it happen. If I get an 88 offer, I'm probably giving you 87 or 87.5. Because we want to give you, I try to make it to where your minimum offer is 87, is what I'm getting at here. So that's kind of where we're going with that. So I hope that answers your note questions. That's how it do. All right. And yes, I do sell notes. I've made a lot of money off of selling notes. Here's a follow-up. Oh, good job, Ika. I appreciate how you put that in there. Grant, so if I buy properties cash and create the notes, will you buy them from me? Yes, absolutely. I will put the buyer in place, use the RMLO process, and deal with the buyer. I will put the buyer in place, run the RMLO process. The deal will be the buyer puts 10% or more down, and the finance terms will be 10% interest in 10, 20, or 30 years. I want to sell the notes at 90% of UPB. If you do that, what you've just listed there, and season it for 6 months, I see no problem with getting you 90. I might actually be able to get you closer to 93, depending, because I might be able to get a 95 offer on that. But yeah, 90 should be reasonable enough until these note buyers dry up when the market turns, because they will. Just be very aware of that. These people, you know, the whole 90 plus UPB thing is a short-lived deal that we need to take advantage of now. But good questions, John. Grant, when you have done a wrap on a property you have acquired via sub 2 and buyer has been in the house 3 years and the bank calls the loan due, what happens to your end buyer? Any steps that you take? Well, I hope that you're not facing that, because that sucks. But there's a lot of things that can be done at that point in time. One is that the due on sale clause is a curative. Well, first, talk to an attorney. That's what talk to an attorney. Not me. I'm not an attorney. But due on sale clause is a curative issue. What that means is that if the issue is cured, that stops the due on sale clause from being called. So one of the things to do to immediately put the brakes on everything is talk to an attorney. You can transfer things back into the seller's name. Everybody's got to be on board with this. Hopefully you have been very disclosing of that this was a possibility to your buyer and to your seller. Because of the specificity of the 3-year thing, I'm thinking that this might be a situation you're actually facing. If it is, I'd like to know what bank is calling the note due, because we like to keep our ears to the ground and everybody can know, what to look out for. But you can put it back to the seller. Then sometimes you can go and put it into a trust to hopefully, add a veil for going back in the future. Sometimes that fixes it. The other option is to do a collateral assignment or hypothecation, which I've had one note in my career that I think may have been getting called. It was actually a Wells note. It was just weird. They just stopped talking to us outright. They wouldn't talk to us or the seller or anybody, and they weren't accepting payments. It was the strangest situation. So rather than messing around with it anymore. I just went to a private money lender of mine and I said, look, this person owes me $70,000 on this house that's worth $90,000. I have a loan for $45,000. Will you give me $50,000 so that I can pay off that loan of $45,000 and keep $5,000 of it myself? And what we will do is, since I don't own the house, I can't put the house up for collateral, right? Like you normally would, a deed of trust or a mortgage, that's what it says. Is it says if I don't pay you, you can have this house. That's not the case with a collateral assignment or a hypothecation because you don't own the house. You can't put it up for collateral. Who owns the house? Your buyer, the person that bought it from you. But what you do own is the note with your buyer. So let's talk about lien position for a second. So the note with Wells Fargo was in first lien position. The note with my buyer was in second lien position. And now I'm going to go in there and get a new note from a private money lender, which is going to be in third lien position. Okay? I can't put the house up for collateral. The only collateral I own is this note to the buyer, but that's in second lien, right? Well, here's the thing. When I get this third lien note from our private money lender, we're using that money to pay off the first lien to Wells Fargo, which bumps everybody up in line, which now means that my note to my buyer is a first lien note. The only thing that defines lien position is the date and time in which it was filed. So the earliest filed note was Wells, that's been paid off. Now the next earliest filed loan is to my buyer, which becomes a first lien position. So I tell my private money person who's now in second position, I say, look, give me the 50 grand I need to pay them off, we'll pay them off. And since I can't put the house up for collateral, if I don't pay you, I will give you the note that I have with my buyer for $70,000. So you immediately, you've got a 50% loan to value ratio. I asked for 50 on a house, or 40, whatever, $50,000 on a house that was worth 90. And if I don't pay you, you immediately get a note for $70,000. So boom, there you go. You got a huge increase right then. And then if they don't pay you, then you can foreclose on the house and you have a house that's worth $90,000. That is how I handled that situation. There are banks that will do that, collateral assignment or hypothecation, as they call it. That would be one way to go. All right. When I tell people I'm going to make payments on their behalf for the mortgage, they then ask, will the mortgage be in your name? I tell them, yes, it will be in their name, and they decide they don't want to do it if it is in their name. So, and I think, Matt, so I think I'm seeing growth here, because I think that like a month or two ago, we were kind of in similar situation. I think it was you. And we were talking about how when there's a consistent reason that people are saying no, it's more likely a problem that you have than it's a problem that they have. So I think I'm seeing growth in the questions here, because I think you've gotten to the next stage, if I remember right, from where you were before in that questioning. But still, here, you need to learn how to address their concerns, right? And so the loan being in their name should not affect them, other than the fact that, yes, if somebody pulls credit, it's going to show up. But why do you care that it's in your name? What is the fear there, right? And so you've got to address their fears. You've got to ask them, well, why is that a sticking point for you? What is it about this loan remaining in your name? Keeping in mind that you should have already explained to them that if you don't pay this loan, that they get to foreclose on you and take it back. Remember our whole spiel about, and it's in the negotiation series, I believe it's in the negotiation series, telling them, look, nobody has ever taken a house back from me, but in that worst case scenario that somebody took a house back from me, I would have come in, caught up the payments, been paying payments on time every month, so it would have made your credit look good. Yes, it's on your credit, but it's going to show on-time payments for going forward. So I'm fixing your credit by catching it up, fixing your credit by making your payments on your behalf on time every month. I'm going to go in there and I'm going to fix up the house to make it worth more. And let's say 4 or 5 years from now, and again, this has never happened, let's say that something happens and I'm unable to make those payments. Well, you get to foreclose on me. And now all of a sudden you get a house back that's worth way more. As things go, property values rise. I can't guarantee that, but it's just how the world works most of the time. Property values rise. So not only is it worth more because I fixed it up, it's worth more because time has gone on and now it's worth more. I've paid your loan balance down for 5 years, so you owe less on it, and it's been fixed up. So you got a house that's worth more, you owe less, and it's been fixed up. So here's the kicker question is, if your worst case scenario is better than the situation you're in right now, why would you not move forward with this? And you also draw to their attention that, you know, and we will keep saying this until this changes, but as it stands right now, we don't. So here's the whole situation for the only other thing that they might care about. You like how I've talked for like 5 minutes and haven't actually said a point on this. I'm like, the other part, blah blah blah. The only other thing that they might care about is that what happens if I want to go get another loan? Well, this loan shows up in my name now, right? So the answer to that is, look, all the way up until about 2014, they used to count this type of transaction. They would count a third of your payment towards what's called your debt to income ratio, which means that they look at all the long-term debt, your mortgage payments, your car payments, credit card payments, minimum payments. They lump that together and they compare that to your pre-tax income as a percentage. That's called your debt to income ratio. When they're giving you a mortgage, that's what they're looking at to see if they're going to be willing to lend to you. They want that debt to income ratio to be under a certain amount. It used to be that they would take 1/3 of whatever this payment was on this house that we're talking about right now. They would take a third of that and count it towards your DTI for the next year. But after a year of showing that I'm paying those payments, they won't count that against you anymore. Well, after about the end of 2014, start of 2015, they don't count any of this towards the debt to income ratios. Historically speaking, what I'm seeing is I've had sellers go out the same month and get a new loan. And as long as they let me know, because I need to provide this new mortgage company with the documentation that shows that I'm the one paying for it. But we provide that documentation and the new lender isn't counting any of this loan against you. So it's there, yes. And we're helping your credit, yes. But getting a new loan isn't even hindered. As long as we're able to talk to your new lender and show them the documentation that shows that I'm paying it, what we've seen is they're not counting any of it. And what we would anticipate is if that changes, it's only going to change back to the 1/3 rule. But I haven't seen any of those things happening in that way. I don't have a crystal ball. It's up to the underwriter. It's an underwriter by underwriter basis. It's up to the lender on how they're going to handle it. But this is how we've seen it handled historically speaking. So that's how I handle that. Do I need a real estate attorney down here in McAllen, or can I use Scott for my deals down here? Yes, you can use Scott for your deals down there. He's statewide. Have you been noticing longer time to sell an owner-financed home? Yes. Seaman, there it is. I've seen an increase in the past 6 months in days on market with other people in my area as well, including myself. Yeah, it is taking longer to sell those homes. You know, sometimes 6 months. But still, the nice thing about a long-term hold is that it just means that you're going to make money. You're still going to make money. It's just going to take you longer to get there. I bought a house sub 2 with a trust. I don't do subject to very often, and from what I understand, this is the best long-term safety precaution. I know this is how you bought your personal home. My question is, how do we structure the deed and paperwork when we go to sell it, which is now? We don't want to scare the new buyers out of the deal. It's a $235,000 sales price with a $30,000 down payment. This right here, we don't want to sell or scare the new buyers out of the deal. That's why I don't do trusts. That's why I don't do trusts. That's why I don't do trusts with buyers and stuff, is that it's confusing to them. They don't own the house. They own the thing that owns the house. It's confusing to them. But I did it for myself because I get it, right? This is a question for your attorney, but basically the answer is when they are contracting the house, the contract, if it's already in the trust's name, they're buying the house from the trust, and the way that the paperwork is going to work as far as you know, what are they getting is they're actually not being deeded the house. They're being given an assignment. I'm sorry, not an assignment. What's it called? Basically, they're making the beneficial interest of the trust is going to be your new buyer. That's all that it is. It's a very simple document at that point in time. It's just, yeah, I think it is assignment of beneficial trust. They're assigning the beneficial trust of that trust, the beneficial interest of that trust to your buyer, and that means that they own the trust. Then the trust owns the property. But talk to your attorney. This is not I'm not going to be able to give you enough here for that to be something for you to take to the bank. You need to talk to your attorneys to get that set up. If I buy a property cash and create a note, at what price point will you buy it? Meaning, what percentage of the discount, or of discount? Example, if I buy it 100K and I get 10,000 down, so $90,000 is left and the ARV is 120. So again, I can't guarantee anything. We got to look at the borrower, we got to look at the paper, we got to look at where it is and that kind of stuff. But probably you're looking at a 90 to a 93% offer in there. Again, I try to get a minimum of 87 to everybody because that's about as low as I've seen offers come in. But it needs to be seasoned for 6 months, meaning that you need to take 6 months of payments from your borrower to get the biggest, to get the most on the note sale. Med says, I'm selling my private home on a wrap. My question is, should I create an LLC prior to selling the property and selling the property through my LLC? I would probably encourage yes. Yes, that's going to be my encouragement, is to do everything through an LLC. Everything that's everything that's consumer facing, I feel should always be done in a trust. And I'm going to show this link of the hot pink home buyers. I very much encourage you to never do anything outside of a trust that's consumer facing. But understand that that means that you're going to have to deed your house to your trust and then go from the trust to your end buyer. Have you considered having a separate deal analysis package that we can pay extra for? Maybe someone from your team could do it since your time is limited for that type of service. We can have appointments set just like at the doctor. I have considered that. You know, it's crazy. There's just so many things that we can do that I have to prioritize, and it's difficult, you know. And I just actually let go. I'm like burned the whole place to the ground up here. So I let go of Fabiola last week. Who was my longest and most trusted employee and who I would still use the word love without hesitation. But I realized that the team that I had built to get here, while that is the team that I needed to get here and who has done a phenomenal job at everything I've asked them to do to get us here, was not the right team to get us there, to the next step of what we need. So I promise this as a point. So I let Fabiola go, unfortunately, and that was really tough. That was very much a business decision that I had to make, and it sucks when you've got people that you care about personally, and I don't know that she's ever going to be able to understand why. And so I'm heartbroken because I know that she's heartbroken, and I had to let somebody go, and she was making good money up here, really providing for her family and everything. So what I'm getting at is I let her go. Jessica is my other employee, and as I anticipated would likely happen from this move, she quit upon the firing of Fabiola. Jessica was Fabiola's friend, that's how she got hired in the first place, and you know, it just didn't work. Now I'm not terribly upset about that because again, the whole team could use a revamping for where we need to go in the future. Now, why am I answering this big dramatic thing right now is I got a lot of stuff going on, and I am now going to be rehiring for positions that we need to fill for moving forward. So I don't know when I'm going to be able to do something like that, but I have definitely considered that to the point that my hourly rate is $500 an hour, and that would be what falls in to this kind of category, is like an hourly analysis kind of thing that can be booked online. We will be doing that likely through the Propelio Academy, as I'm the dean of the academy over there. So I've got control of the build out of what's going on. But that type of deal will likely be coming more so through the Propelio Academy, just because I've got different resources to use over there than I do over here. But it's a good idea. Sorry for that big, long rant there. I'm just letting you guys know everything that's going on because, hey, that's part of my job and my calling is to be open books. How local/community does a bank have to be CCF friendly? e.g., would Frost or Pinnacle be good ones? I'm not familiar enough with Frost or Pinnacle. Here's kind of where I would say is kind of the drawing line. If I walk in, like I went to the bank yesterday or the day before. No, Friday. I went to the bank on Friday because I needed to change the signature cards and take Fabiola off of the account. That's how much I trusted Fabiola. She was a signer on all of my accounts. Which should just all the more say how hard of a business decision that was. Anyway, I went in there to take her name off. I haven't been in the bank. I haven't actually been physically in the bank in months. But I walked in, and like the president of the bank is like, "Hey, Grant." Like every single teller's like, "Well, what's up, Grant?" Everybody knew who I was. I can sit down, and I don't have to show ID. They just start showing me the things about my accounts. That's the kind of bank you want. The bank where it's like Cheers and you walk in and they're like, "Norm!" Like that's what you want. You want that kind of relationship with your bank. If Frost or Pinnacle in your area is going to offer you that, probably okay. But the challenge comes with these national branches with use of like things like powers of attorney is if everybody that could possibly make a decision on that loan and has the power to make, or I'm sorry, on that, whatever it is that you're dealing with on that transaction, I want everyone, every possible decision maker to be in that branch or a phone call away. I don't want, well, we've got to fax this in and send it to our legal department. That's when things start to fail. So that would be my line drawn. Deverson says, "Hey Grant, I'm based out of Minnesota." What's up, man? Welcome from Minnesota. "I'm working with a seller right now that has a 25 single-family rental properties. That's awesome. I'm not sure what the right strategy would be to make money on this." Deverson, welcome to the world of not giving nearly enough information to get an idea of what's I don't know what you want me to do with that, man. But it's awesome. It's awesome that you have that lead. That's great. There is not even an inkling of enough information for me to do anything with that. But that is awesome that you have that lead. You've got to run it. I mean, you got to find what's owed, what does a person want, what are the properties worth, what kind of repair state are they in. You got to know all the answers to all the same questions that you would on a single family, and then just apply that out to all 25 of them. It's great to have leads like that, and you can you know, with package deals like that, I mean, you can really make your career off of taking that down. But you got to know the numbers. Without numbers, nothing matters, right? So you got to know what are they worth. It's going to take a long time to go in there and analyze each of them, and you need to tour them. You know, one of the things to do is get it under a contract, because you know, a seller of a big package like this is not going to allow you to see all 25 of them yet. So what you need to do is you need to go and you need to say, "Look, I'm serious. I can do this. I need to see 3, 4, 5 of them to get a sample of what kind of condition these properties are going to be in. Once we see that, we can run some initial numbers of getting an idea of what the rehab is going to be. What we'll do is we'll contract with you under an option that says, this is our offer, assuming a average rehab budget of X, and then you tour every single property and you get a rehab budget on every single property. And if that all comes together and works, then you close on the deal. But do not let them say, "Oh, well, you can't see them," or "I don't want to scare off my tenants," or anything like that. Those are red flags. You need to see every property, and you need to get ARVs on every property, and you need to get rehab budgets on every property, because the fact of the matter is, you might be at a crap deal on one of them, but 3 other deals in that package are so phenomenal that it's okay to lose money on this one, because you're still going to be netting best. Okay, so what am I doing? Where's my mouse? Where's my mouse? I feel like an old man. Where's the mouse? What if the note is not seasoned? You're not going to get 90%. I will be buying the property and creating the note. Will you buy it at day one and double close? And if this is the case, at what percentage will you buy them? 87% or more? Hell no, not going to happen. At that percentage, you're looking in the 70s if you want same day closes. What would be a fair price to pay for a wholesale deal if someone has a note and they want to sell it to me? 1, 2, 3, 4, 5K. What would be a fair price to pay for a wholesale deal? Okay, if someone has a note and they want to sell it to me. Are you asking like if you wanted to kind of broker that to somebody? Like say for instance, they had a note for sale and they want 87,000, but you know I would offer 90, and so you're trying to see what is fair for you to get in the middle. I'm not sure that I understand what's going on about that. Sorry, so I'll need more information on that one. Matt says, are you closing on the seller finance deals with your own money? No, I'm not. If not, how long is your option period so that you can find a seller finance buyer to piggyback on that deal analysis, on the deal analysis team on your side? Maybe creating an Excel spreadsheet would help analyze the deals. Yeah, and you know, it's possible. Again, time goes into that, you know, on analyzing the deal. It's, you know, you're right. My option period, if I'm going to try and find the buyer before I close on the acquisition, we shoot for 90 days. In hot markets like this, it's down to like 60. But in the turn, you can typically do like a 90-day option period to make that work for you. I'm not sure if I dozed off at some point. I haven't seen anything on your seller financing package explaining how to find leads. Can you help give pointers, please? Actually, Fanatic for Hockey, it's funny you say that because at the beginning of today's episode lesson, I said, I'm not your lead gen guy. I'm not the guy that teaches you how to get great lead gen. So yeah, I teach you how to make deals work. I don't teach you where to go get them, but I will tell you the answer that nobody wants to hear, which is they're in every other deal. The same lead gen you've heard of or any other deal is the same lead gen you use for your owner financing stuff. So I wish I had a sexier answer for you, but that's what it is. I got my first rental recently with hard money. It is currently rented. What banks do you recommend to refinance out without needing too much paperwork? Happy State Bank can work. Texas Republic Bank does really well on investor loans. Those would be two that I would recommend. I have a question concerning a possible sub-2 deal. The potential seller is interested in what I can offer and I asked her to get her mortgage data from the lender. I followed up with her several times, and this particular lender is really giving her the runaround on why they won't and can't provide that info. My humble opinion is hers, and she's entitled to ask for it and receive it. Any suggestions? Yeah. So my my position on that is kind of sixfold. I mean, first, getting just the mortgage statement, the most recent mortgage statement, should give you all the information that you need to know. For the most part, maybe not all of it, but it gives you enough to get an idea. And then another thing, you know, on the first appointment, part of my acquisition team's process is you call the bank yourself with them there so they can authorize you. A verbal authorization with the bank's last 24, usually sometimes 48 hours. And then you ask the questions that you need answered as far as what's owed, what the back payment, what the back payments are, and interest rates, and anything that you might not have. You get those questions answered because you know how to talk about mortgages, and they may not. But we can only do what we can do. So, you know, if it's a possible sub-2, again, does she have an online login? Does she have? If not, can you help her create one? This is a matter of going to the appointment with a contract in hand, ready to help her create her online login and look at stuff, ready to look at her most recent mortgage statement and see if it's within enough range of being able to make an offer that makes sense, and also being able to call the bank yourself with a verbal authorization from your seller so you can get the answers that you need. Mitchell says, since we bought the house sub-2 in a trust, are doing a wrap, would it be okay if we actually just deeded the property to the new buyer with a note? Well, I mean, you could deed it from the trust to the new buyer, yeah, and did a note from there, yeah, the trust could sell it and then basically, but the trust at that point in time goes away and is out of the transaction. But yeah, you could absolutely do that. The trust has the ability to sell that. Matt says, you say you did well in the down market, but in the down market, don't sub 2 deals become more risky because property values are dropping and you run the risk of being upside down on your sub 2 deal? No, and I wouldn't say so, because here's the thing is that in those down market, I mean, it's a good thought process. I appreciate the thought process there. But you're selling these homes in down markets. You've got, and we've talked about this before too, of like, you've got so many people that want to buy houses but can't because lenders don't lend anymore. But there's still people with cash. There's still people who want to be homeowners. So you've got a huge amount of people, more so than you do in an up market, ready to buy an owner financed property. And so the days on market become very low, typically, a week or 2, maybe 3 on these down markets on a sale side. And if you think about prices dropping, prices are typically not plummeting to a point where 1 month or 2 months is going to make a big enough difference for you to be underwater on a deal. And if it does, that's an extremely tight deal. And that is why we employ the 90-day option period, and we wouldn't close with our buyer until we have, close with our seller until we have a buyer in play. So all of these kind of things kind of protect you in that realm. And then the other nice thing is that even with property values going down, part of the beauty, I mean, it's kind of the opposite reason of why people, so like people who are a proponent of landlording don't like the owner financed idea, because you don't get the appreciation, because once you sell, you've locked in your equity, right? You've locked in what price you're going to get on that deal because you've sold the property. Well, it's similar in the opposite direction, but now it becomes your advantage is that you've locked in, you're going to get that equity, even if the property values go down past that. Doesn't matter, you've locked in what you're getting, right? And they give you a 10% down payment, which you can use to pay off that underlying mortgage or whatever that might be. But that's not been, I mean, we do very well in down markets. The down market is where it's at with owner financing. Okay, that looks like I have achieved the end of our question. So you've got another couple of minutes to get in some questions here. And let's see if there was anything that I needed to address. Oh, yeah, John says, broker it. Yes, you have a note under contract and offer it to me. What would be a fair price for it, 1 to 5K or less? Well, again, there's verbiage there that confuses me. You said you have a note. You, in that context, would be me. I have a note under contract and offer it to me. That's not gonna happen. You being one, somebody else has a note under contract and offers it to you. It's typically, I mean, it really depends on the offer. It's kind of, that's like saying what's a fair wholesale price in general. Like, well, it depends. Do you have a deal at $30,000 that's worth 90? Well, a fair wholesale price might be 30 grand. Do you have a property under contract at 80 that's worth 90? A fair price might be nothing. So, so it just really depends on that. Here's another question coming in from our Sean and Vicky. Are lease options illegal in Texas? Are they ever a good idea or alternative to seller financing? I use lease options. So in some ways, the lease option rent to own is not illegal necessarily, but it's got a lot of restrictions on it. You can only be in the lease period for up to 180 days before you must transfer title to your end buyer. I use that all the time. I say all the time. I've used that quite often. Say somebody doesn't have enough for a down payment or something like that. We can give them that lease period to make up what they need. But you got to transfer title in that 180 days. If you jump through a bunch of hoops and you have underlying lender's consent, you can go up to 3 years. But we typically say 180 days. And Ika is saying, Andrew, I can't find your questions in our mailbox. We did have a weird problem with our questions at mailbox. I think somebody had signed in with a POP account and it downloaded a bunch of our emails, and I'm not sure what happened to that. But anyway, so if you're in another state, lease options are awesome. And you should definitely be employing the lease option, the rent to own, the contract for deed, that kind of stuff. Texas is tricky. There are situations where it's a good supplement, but I do not think it's ever a good replacement for seller financing. And Wade asked what the hypothecation bank in Waco was again, and they actually stopped hypothecating. So I don't remember their name, but it doesn't matter anymore because they've pulled on that strategy. Matt says, I have a fear of not being able to get a seller financed buyer if I had it under contract. Have you ever been in that situation? Maybe when you were newer to the game? And yeah, I mean, that's why option periods are so important. Is just like with a wholesale deal, if you got it under an option period, then it doesn't matter. So I would encourage you, especially at the beginning of your career, to use those option periods. And Andrew, I would encourage you to, oh, weird. I was going to say copy and paste it here. We'll see. We'll see if we can get to... Oh, you know what? Actually, I might have the questions box on my email. Hold on. Yeah, no, I don't. So, Ika, we'll see if I can Ika can get to those. And in the meantime, I will look. Yeah, Grant Kemp is not an attorney. Yes, thank you. I appreciate that. Matt says, awesome video last week. I have the same issue with wholesalers not offering comps or a reason behind price. It's amazed me how many wholesalers I can call and get zero responses. Are you talking about the Grant Teach Me Something episode? Yeah, that was a fun one. Okay. Oh, yeah, sure enough, we do have other questions. Okay, so here's the other questions, 4.1, 4.2, and 5. I'm listening to Chapter 14 now. Do you mandate to the end buyer that they have to use your insurance agent so that this is done properly? Absolutely not. That's illegal. Or do you just mandate that you have to coach the buyer's agent through the insurance so that we do not unnecessarily trigger the due on sale via a crap insurance policy? No, you cannot force an insurance policy or agent on your buyer legally. They have to have the right to choose. But you can enforce what is and is not an acceptable policy. And so in our terms, that means I require RCV. I require the coverage to be the loan balance. And I require the names to be listed correctly, like we've talked about before. That's my requirement. I don't care where you go. That's my requirement. I just heard him speak to this issue. I bet my life most M buyers want crap policies to save money. You're absolutely right. Are you then just demanding as part of the contract dealing signed off by both you and the buyer that you get to get contact with the buyer's agent so this is not screwed up? That is a legal right of being a lender, is that you get to, like, you don't have to have that all outlined in the contract because that is a legal right of yours as the lender that you get to approve or disapprove insurance for whatever reason you want. As long as you've got policy behind that. So again, like I said, RCV, minimum loan balance, or minimum coverage of the loan balance, and the names being in the right place. That's what we want. Team, why are folks using a trust to close the acquisition on sub-2s? I imagine they feel that it cloaks what's happening in some secrecy, but even that act violates most lenders' due on sales. What other reasons? That is the reason. It is purely a cloak. It is not a solution because you're right. It does still violate the lender's due on sale clause. And I don't like using the word violate. I like using the word trigger because it's a triggering clause. It's not don't do this or we will. It's if you do this, then we can. So we are triggering the due on sale clause. We are not violating it. But yeah, the simple fact of the matter is, if that person is selling their house, that is a trigger of the due on sale clause. It doesn't matter if it goes into a trust or if it goes into an LLC or if it goes into your personal name, that triggers the due on sale clause. The reason why people are doing that and getting success in it is that the Garn-St. Germain Act of the late 80s or mid 80s said that if you put a property into an estate planning trust, that did not trigger the due on sale clause. So banks have, you know, the idea that if it's going into a trust, if it's an estate planning trust, then it doesn't trigger the due on sale clause. Well, what defines if it's estate planning or not is only going to be seen through subpoena, because that's not public record that gets that filed. So are they going to go through all the effort to find that? Maybe, maybe not. So that's where the cloaking comes from. And then he asks, who are my Northern Colorado CCF members? I don't know if you have any other ones, but we'll put that out there. We'll see who else is out there. All right. Can you explain how to do a lease for the remainder of the loan and be in second position to prevent liens? I'm going to read that again. Can you explain how to do a lease for the remainder of the loan and be in second position to prevent liens? I mean, I wouldn't do that, but I mean, it would just simply be that you have a lease with the right to sublease or the right to, well, I guess it would have to be sublease. I mean, it's an interesting thought, and it might be something that's more prevalent in another state. This sounds like something that a Floridian guru would say. Damien, where are you from? Are you from Florida? Or did you hear this from somebody in Florida? He's in Colorado. I was wrong. That's awesome, though. Yeah, I don't see really any. I mean, I can see why, but if you are the lessee from your seller, you don't have the power to sell the property, and we do want to sell the property to get the. Now you can do contract for deed, I think, in Colorado, which it seems like you're in Colorado. Oh, and he says lease option. Gotcha. Again, I'm not your lease option guy because we don't have lease options as really an option in Texas. But what you're looking for is called a contract for deed. And basically, it's kind of like a lease option. Basically what it is, instead of saying, I'm going to sell you the house and, you know, you're going to get the deed from day one and pay me this amount of money for the next X amount of years, you're going to say, I'm going to give you a... it was a Floridian guru. Woo! I'm going to give you a contract that says if you pay me $756 a month for the next 30 years, or whatever the equivalent would be with interest and principal if you pay it off early, then I will give you the deed. That is contract for deed. That doesn't require filing, from my understanding. But again, I'm not that guy because I'm not. We're only this year making a national push to help people in other states. So we have a very clear plan with that, with attorneys that we are working with to go into each of these other states. And Andrew has already figured out how he's going to make Colorado one of my next priorities. Arizona is really our next priority. Colorado could come after that. But we will be learning more about your stateside stuff, but my default is you need to talk to a state local attorney on how to handle that. What is the best way to smooth it over with a seller if the deal didn't close? That's a good question. What is the best way to smooth it over with a seller if the deal didn't close? You know, the best way to smooth it over with a seller without a deal or with a deal that's not closing is being upfront about it before it's ever even an issue, letting them know it's an option. That's the best way to smooth that over. I've done maybe 1 or 2 contracts. I don't know, maybe more, because I don't remember those deals like I would. Anyway, I've had it where I don't close on the sale side, on the acquisition side. I'm sorry, but nobody's ever mad, because those deals were deals that when I contracted it, I was like, look, this is super tight. No cash buyer is going to be able to do this for you. I have a chance of doing this for you. I don't know even that it's going to work out, but I'm your only option. So let's try. But in order for me to put my time and effort into it, I need to have a contract. Otherwise, it's pointless for me to go out and start searching for this stuff. I've got to know that as soon as I find somebody to buy this at the price that it needs to be bought at for this to work for you, that you're not going to back out on me, and I've done everything for nothing. So let's sign the contract. I'm going to have a 90-day option in here. During that option period, I'm going to go be looking for somebody. And again, this is where I'm like being a guru and being like, yeah, I get a 90-day option. This is the typical guru thing. 90-day options aren't a thing right now. But the last time that I had to do this, they were. So just know, like in the downturns, yeah, you can hit that 90. The gurus like to talk about how successful they were in the 90s and tell you all these things that worked in the 90s that don't work now. That's what's happening when I say 90-day options. Don't feel bad if you can't get a 90-day option. That's not a low. I can get 60-day options right now. 90s aren't happening. Anyway, let's say 60-day option. I'm going to put a 60-day option on this. I'm going to go try and find another buyer. And if I can find somebody to buy it from me, then I will close with you. But I'm not 100% on that. And part of my credo, part of who we are, is that we will never lie to somebody and we're never going to mislead them. So I want to be very upfront with you. I'm your best chance. I'm pretty sure I can make this happen, but I'm not 100%, and I need to be upfront about that. So that way, whenever it doesn't close, you can say, look, I told you that this might happen. The problem is if you mislead them and they think that it's going to close for sure, and then it doesn't. We have a house we bought sub 2 in a trust. Could you help me out with the best way to sell the house on a wraparound mortgage beside assigning the trust to them in an effort to not scare them off? I thought that we just talked about that, Mitchell. Deeding the property out. Yeah. So yeah, I mean that's what it would be. Is like like first try and explain to them. You know, just try sell it to them as normal, and then say, look, explain why the trust is there, because we're going to be explaining the due on sale clause anyway. So it's not to say that they're going to be scared off by a trust always. It's just extra steps and stuff that I like to avoid. Just explain to them why you're doing it. Explain to them, hey, this is this has a lien. That's the reason we're able to offer this house to you, is that it has a loan on it from Bank of America. That's the only reason that this is even able to happen for you. But every loan has something in it called the due on sale clause, and you can watch my videos on the Academy on how to address due on sale clause. Every loan has a due on sale clause in it, and the best way to avoid that ever being an issue is to put that property in trust. It's not a 100% guarantee, but that is the best way to avoid this becoming an issue. So what's going to happen is you're going to buy the house, but really what's happening is you're going to own the trust that owns the property. Very much like I own an LLC. I own a company called whatever, Home Buyers LLC. That company owns all of my properties. That's how I do it. I protect myself by owning a thing that owns a thing. That's what you're going to be doing here, is you're going to own the trust that owns the property. Right? So just explain it to them, and it shouldn't be an issue. Wade says, a claim check process covered. Thanks. But what if the buyer doesn't have the cash to cover the deductible? Yeah, that sucks. And you know, the thing is, and I hate, this is my least favorite. Sorry, I just realized I did that whole explanation to you as a tiny man on the side. It's my least favorite part of, well, maybe not my least favorite. This is one very, I don't like this thing about this business, which is you may have to foreclose on somebody simply because they don't have the money to fix their roof. That might happen. But that's part of home ownership, dude. You want to buy a house, you've bought a house. If you didn't want to have to plan for contingencies, you should have rented. But you got to have the money to fix this house. And the reason why we're lending money and we're allowing somebody to make payments on this house is that our investment is protected by collateral. And if they don't put that collateral in a position to remain worth our investment, that kills the deal. And part of the deed of trust says that they're responsible for making sure that the house is kept up in good condition. So it is a violation of the deed of trust if they don't have the money for a deductible that it takes to get work done on this property. So there's a couple of ways that you can handle that. Either you can finance them the money, and look, I will give you the $1,500, but you're going to have to pay me an extra $15 a month for the next, whatever that would be, 100 months. Or it's a foreclosable offense. The last thing I want to do is foreclose on somebody who's making their payments but doesn't have the money to fix a problem that occurred from hail damage or something like that. But I've come this close to doing it. I mean, I had to sit a guy down in front of me and make him repeat the words back to me that if he did not fix his roof in the next week and a half, he was going to lose his house to foreclosure. And I literally made him say that. I'm like, sir, I'm sorry, but I need you to literally tell me these words. I need you to literally tell me if I don't fix my roof in the next week and a half, Grant is going to foreclose and take this house from me. I made him say that to me. We gave him every chance he could, and then guess what? He fixed the roof. That's the thing. People don't have the money until they're going to lose the house, and then they magically came up with the money. You're going to get played a lot. People are going to lie to you a lot about what they can and can't do because they are used to lying. They're used to getting away with things, that kind of stuff. You'll be amazed at how often a stern phone call transfers somebody who just can't to all of a sudden they're giving you their $2,500 that they were in back payments. So that's what that is. If I have a note and it's wrapped, can I sell it partially for a 5-year period and get it back? How would I structure it? That's kind of an Eddie Speed special. So let me show you how you look at partials, which is pretty cool. So remember when I said that everything is based off of yield on notes? Well, this is a $90,000 note originally, right? At 9.5% for $756. So what if we had an investor who needed an 8% yield? Or we had an investor, let's say, so I'll do two different things. Let's say we have an investor that needs an 8% yield. Well, we would put 8 into the yield, and now instead of solving for the PV, which would be a discounted note, what we're going to solve for is the number of payments. So in order for $756 a month, and let me put it this way, in order for a $90,000 investment, which is what we want them to pay us the full price. We want full UPB on this loan, 100%. So in order to get $90,000, which has a payment of $756 a month, to yield 8%, we need 237 payments. So we would sell them the next 237 payments, and we would retain the remaining, whatever that would be, 123 payments. That's a partial. Now, I don't have the paperwork for you on that right now, but if you get a note buyer that wants an 8% yield, you can let me know, and yeah, we can help you. Brady says 121 is a partial note lesson, and I'm not sure what that means because I don't see a video or anything like that got listed. So yeah, I'm not positive, unless that's like the 21st of January or something, but I'm not sure. I'm not sure there. Okay. Ika, I don't think that we have the full question here. It just says, so it doesn't change title and trigger due on sale. Maybe what we're talking about probably was the trusts at that point in time. And title does change because title goes into the trust. But the thing is that the banks are aware that the Garn St. Germain Act exists, and that if that trust was... Oh, Brady says it's the video timestamp, like 1 hour, 21 minutes. Nice. There you go. I like that. Thank you. Banks know that because of Garn St. Germain, if it goes into a estate planning trust, then it's not a trigger of the due on sale clause, so they typically don't investigate, but they can. They can investigate that. Could you please email me the contact you use to do the deals? You mentioned a law firm you use and you mentioned we can leverage it to piggyback on the deal analysis team on your side. Maybe creating an Excel spreadsheet would help analyze deals. Hold on, I don't understand. Could you please email me the contact you use to do the deals? I don't know which contact you're talking about. Are you talking about attorneys? If so, if you go to the resources page, there's links and emails and stuff there. You mentioned a law firm, that's why I'm thinking attorney, you use, and you mentioned we can leverage it to piggyback on the deal analysis team on your side. Maybe creating an Excel spreadsheet would help analyze deals. Yeah, I'm sorry, I just don't follow you there, I'm sorry. One of the modules, Grant explains how to fill in the contract. Wish he expanded on it. On that module, he talks about a law firm that did it and that we can leverage it from him. That's what I understood. Horn and Associates is who did that, and their contact is in the resources page. Did you place contract language or addendum language on the CCF website? You guys may use something that enhances what an attorney here may suggest. No, that's part of our national push, is getting contracts nationally. But until then, I'm not even going to mess around with the liabilities of that until I have an attorney in each state telling me what that state really needs. That's just a massive liability for me to start talking about contracts like that. I know you're looking to grow your company and replace the people you had to let go. I may know somebody. What is the best way to get in touch with you? You can email me, grant@CreativeCashFlow.com would be good. I will give fair warning, I'm not planning on hiring anybody inside of the industry. I like to hire outside of the industry for many reasons, but I appreciate any kind of contacts. What I'm looking for is somebody whose primary goal in life has been marketing. That's what we're looking for. Somebody whose primary goal in life has been marketing and whose secondary goal in life has been business building and growth of sales in some sort. So that's really what I'm looking for. Are sub 2 wraps going to be legal in Texas now? They always have been legal in Texas. That's what we do, is a sub 2 wrap. So I'm not sure what that, unless you're saying illegal, in which case, no, they're not going to be illegal either on that. You're probably referring to the what's the word I'm looking for? Legislation that was going through the Texas stuff. And we've got some updates on that. It looks like that might not be going through at all, which really is fine for us. But I sat down with all the most important people in the state for all of this stuff, from the senators to the, freaking SML commissioner to everybody, and got the language that we needed in the bill. So if it does pass, we're good. But it doesn't look like it's going to get through the House. So we'll see what goes on there. Okay, John says, I was asking for a copy of the contract you used from Horn and Associates, which I'm not allowed to give out. Scott doesn't like those things being given out, unfortunately, which is why we're building our own contracts. But again, that's just another... You guys have seen 14 things that are like, yeah, that would be great to do. Imagine all the other millions of things that are going on behind the scenes. I got a big line of to-dos, and I can't get to all of them. But one of them is we are creating contracts to give out to all of the students because we were unable to do that. And the other question was, had you created an Excel spreadsheet that would help us analyze deal ROIs? No, I haven't, but no, I haven't. I gave you videos that show you how to do it, but I don't have Excel spreadsheets. I don't use Excel spreadsheets for that. Scott will send you the contracts if you have a deal. He's fearful of people taking the contracts and going and using them on another attorney, and him not getting any payment for all of the work that he has put into making sure that these contracts are solid, which is understandable. But yeah, if you've got a deal on the table, it's go get it contracted with the normal sales contract, and then go to Scott and let him know, and he'll fill out the addendums for you and get that all handled up. All right, it's been an hour and a half. I think we're to the end of our questions, and I'm gonna call it. So you guys are awesome. Thank you for being here. I appreciate it. We will be picking this back up again next week. Same bat time, same bat place. 7 o'clock p.m. Central, Monday nights. Again, you guys are awesome. Love having you guys. And I will see you next week. And yes, Sean and Vicky are correct. Ika, you rocked it. Thank you very much for putting all the questions out there. You're amazing. We will see you guys next time.